Assalamu alaikum class. In this lecture, we will discuss problem number 10.3a from Williams Haka Bettner book, Financial and Managerial Accounting. In this lecture, we will learn how to record or how to pass journal entries related to notes payable in different scenarios and how to calculate interest expense on the note payable. So let's begin with the Excel sheet. Here it is. We have different transactions involving notes payable are given. Then in requirement A, prepare adjusting entries. In next requirement, we will prepare, in requirement A, we will prepare journal entries. And then in next requirement, we will prepare adjusting entries. And then there is one explanation is required, so we will see it after completing the entries. Start preparing journal entries. So first transaction is on August 6th. The company borrowed $12,000 from Maple Company, signing a 45 days 12% note payable. So this 12% represent rate of interest. The entry would be on August 6, 20. Year is not given, so just August 6. As the company borrowed money, so cash will be debited and notes payable is on the credit side. So the debit amount is $12,000 and then notes payable is also for $12,000. In the second transaction is done on September 16. The company purchased office equipment. Invoice price was $18,000 and the company used a note payable as a full payment, 10% rate. 3 months notes payable means the company will pay it after 3 months. So right now on September 16, the entry would be the company purchased office equipment, so asset will be on the debit side, and then notes payable or the liability is on the credit side. The amount of office equipment is $18,000, so the note payable is also $18,000 because note payable is accepted as a full payment of office equipment purchase. Next transaction is on 20th September. The transaction is Maple Company paid Group Bank the note plus interest accrued on it. So it is on August 6th, the bond uh, note payable was for 45 days. So after completing 45 days, the company will have to return this amount, including the interest on it. So September 2nd, notes payable is a liability. And as the company is returning it, so it should be on the debit side, notes payable. The company recorded interest expense on it. So how you are going to calculate interest expense? Total note amount is 12,000. So 12,000 multiplied by interest rate, which was 12%. So 12%. And then convert the yearly depreciation into 45 days. And the company has mentioned, or the company is using 360 days a year. Generally, if 360 day a year is not given, then we can use 365 days. But in this case, 360 days a year is given. So we divide this complete transaction by 360 days and multiply by 45 because we are calculating 45 days interest. And we will credit cash. The cash amount would be notes plus interest expense amount. So here, notes payable is for $12,000 and the interest expense will be 12,000 multiply by 12% divide by 360 days and the whole will be multiplied by 45 days. So in this case, here we use the bracket. Here, this is one bracket. Okay, so the interest amount is 180. It should be on the debit side, and the total cash amount, cash, uh, the company paid principal plus interest, which is 180. So this is the complete entry on September 20th. The next transaction is on 1st December. The company purchased merchandise inventory. So company purchased inventory amount $5,000 from the company and 90-day note, 14% rate of interest. Company using a perpetual. So inventory would be recorded. So we are going to record the transaction December 1st. We debit inventory account because the company is using perpetual inventory system. If the company is using periodic inventory system, then we debit purchases account. Complete chapter 6 lectures are also available. You can search it in the playlist. So inventory is debit and the amount is not paid. It will be paid after 90 days. So notes payable is on the credit side. How much amount is involved? $5,000. So $5,000 will be debited and same $5,000 will be credited. The last entry is on 16 December. The entry says $18,000 notes payable today. The company paid accrued interest on this note and issued a new 30-day note, 16% note payable. Okay, so the company purchased this equipment for $18,000 and the amount is due after 3 months, that is on December 16, means from September to October, October to November, and November to December. After 3 months, this amount is due on 16th December. But the company extended the payment date by converting this 10% note into 16% note payable. So again, the entry would be on December 16 and notes payable will be debited. Notes payable, and this note is the new note which is on 16% rate of interest, and the company also will have to pay interest expense on the previous note. So interest expense, uh, the amount is 18,000. So this 18,000 and the rate of interest was 10% divided by 12 multiplied by 3. So this was the interest expense which was due on previous note. The new note, the previous note, this is old note on 10% rate, and the new note, notes payable, which is new note at the rate 16% of interest. And on this note, company will have to pay interest expense, or you can say cash, on the previous note that was issued on 16 September, or you can say that was due on 16 December. So notes payable amount is same, new note and old note, 18,000 and 18,000. But company will have to calculate interest on it, and the interest expense is 18,000 notes multiplied by total interest is 10% at that time, so 10%, and the company will divide this mm, interest by, because this rate of interest representing 12 months, so, so company will multiply it by 3 and divide by 12. Multiply by 3-month interest is there. So company is going to, now we will divide it by 12 first, and then divided by 12 first, and we will multiply this amount by 3 months. So total amount is 450. So this 450 cash is paid, and this 450 belongs to this amount which was issued, this note payable which was issued on 16 September. So converted old notes payable which was due on December 16th into a new note payable which is going to be paid after a 30 days. So this was requirement A. In requirement B, adjusting entry is required to on December 31st, and we have three different type of notes. This one, notes payable, and then we have this notes payable, and then we have this notes payable, and then we have this note payable. So we have closed, we have paid or closed this note, the first one. So we are not going to pay any sort of interest on this note because we have paid the note payable amount before 31st December, and interest, we have already paid interest on it. But this note payable is again, we are not going to pay any amount on this note payable because this note payable is converted into a new note payable. So new calculations are required. Here I'm going to calculate interest expense, adjusting entry. Here I can write adjusting entry. Okay. So adjusting entry we have discussed in chapter 4, and I have uploaded a video related to adjusting entries. So here, the same entry we are going to pass. Interest expense will be on the debit side because we are recording interest expense, and interest payable is on the credit side because we are accruing interest expense. We have different notes outstanding. Okay, number one, we have missed this entry. We have missed this entry, so we can write it on the end. In the end, we have missed the one entry, which is on November 1st. So after September, we have November 1st entry. We should have this entry. So we can write it November 1st. Borrow 250. So company get cash 250,000. This is the rate of interest. So cash will be debited, whereas notes payable will be credited on. Here it is. And how much amount? Amount is 2,50,000. And then $2,50,000. And this amount is due on after 90 days. So this is in November, December. So we are not going to pay on 31st December, just accruing interest on it. So first note payable is here we have note payable. We have three types of notes right now: rate of interest, interest rate, and then we will calculate interest expense on it. So you can see first note is from start. We have paid this note, so we are not going to calculate any interest on it. On 16 September, we have converted this note into a new note. So this note is converted or cancel out, or so we are not going to calculate interest on it as well. Then this one, $250,000 note. So 2 lakh dollar, 2,50,000. Rate of interest on it is 15%. So 15%. Now, uh, November 1st to December 31st means 2 month note. We are going to calculate 2 month interest. So $250,000 multiplied by rate of interest is 15%. Then we are going to divide this amount by 12 because to convert this interest expense into monthly expense, and then we will multiply it by divided by 12%, and then multiply it by how many months? 2 months. So the interest expense on this note is 6,250. So the next note is this. We use it for purchasing inventory, $5,000. And we use this note on December 1st, 90 days. So we are going to calculate interest for 30 days only, or for 1 month only. Rate of interest on it is 14%. So we are calculating it in a similar way how interest total note payable is 5,000. Interest expense interest rate is 14%. Divide by 12, multiply by 1 month. We are going to calculate it for 1 month, which is $58.33. Next note, which we have converted old 18,000 notes into a new 18,000 notes. So this is $18,000. This note is $18,000. So the rate of this note payable rate of interest is 16%. And how we are going to calculate the interest on it? The amount is, total amount is 18,000. Rate of interest is 16%, and total interest is, here you can see, uh, from 16 December. So we divide it by 12 and multiply it by half. Why half? Because we issued this note on December 16. So we cannot take a whole month interest. We will have to divide 1 month interest into half, because we issued it for uh, just 15 days earlier. So we take 15 days interest, which is 120. So total interest expense, which is accrued on December 31st, is 16,428.333. So we are going to pass this adjusting entry on December 31st by how much amount? This amount. Oh, oh. How much amount is there? Dollar 6,428.33. Dollar 6,428.33. So in part B, we passed adjusting entry and we record interest expense on the uh, notes payable. This interest expense is due on December 31st on several notes payable that are still unpaid. What is the third requirement? Provide a possible explanation why a 30-day new note payable to the company pays 16% instead of 10% rate change on December 30th. This you can see this one on this date, we have converted a new old note payable into a new note payable, and previously it the rate of interest was 10%. Right now the rate of interest is 16%. So the company note dated on 16 September was due in full on December 16. The higher rate of interest on the new note may be associated with the increased risk of collecting in 30 days, because the company, the 18,000 was due on 16 December, but the company was not able to pay even this note within, 3 months time. So how can the company can pay this note in 30 days? So the rate of interest is increased because the risk is also increased. So we have learned a rule in chapter 6, cost of money, that higher uh, the rate of return is involved, the higher risk is involved. More risk means more rate of interest. High risk means, or low risk means low rate of interest. So now the company's risk is increased. That's why the rate of interest is also increased. So that's it from this lecture. Take care, class.